Last year, private equity firms sold $116 billion worth of American companies. They sold them to themselves, not to a competitor, not to the public market. The same firm that owned the company set up a brand new fund, raised fresh money into it, and had that new fund buy the company out of the old fund. Same manager, same building, same man signing both sides of the paper. And the price he paid himself came in 2.9% below the value he had already told his investors that company was worth. 2.9% on an asset with no market price at all. The buyer, the seller, and the appraiser were the same person, and the appraisal came in almost exactly where he needed it to. That is a strange thing to do with $116 billion. It is not a new thing. There is a specific year when America ran this exact machine at scale, and almost nobody noticed until it was much too late. Everybody remembers 2008. Almost nobody remembers 2006. In 2006, American house prices hit their all-time high, record highs. And in that same year, at those record highs, subprime borrowers started missing payments in record numbers. Both true, at the same time. Record prices and record defaults. Almost nobody can tell you why. That same fingerprint is on something being installed into American retirement accounts right now, under a rule published on the 30th of March. $49.1 trillion sits in American retirement accounts. That is the pot. Washington has proposed opening it. And sitting on the exact same government list, in the exact same rule, is Bitcoin. One of those two things has a man who sets its price. One of them does not. Nobody is going to circle the right one for a 68-year-old man reading a plan menu. I have had one specific number on my screen for weeks watching this develop, and I will tell you which one shortly, because when you see what it does, you will want it on your screen too. Let's start with the loan. In the early 2000s, if your credit was rough and you wanted a house, the product they handed you was called a 228, 30-year mortgage. Two numbers. For the first 2 years, you paid a low fixed rate, and the Boston Fed's own data puts that starting rate around 7.3 to 7.5%. Then, at month 25, it flipped. The rate reset to fully indexed, which in those years landed around 10.5 to 11.5%. Your payment jumped roughly 25% overnight. Read that as a normal person, and it looks like a trap, a cruel one. It was not a trap. And this is the part that matters. Nobody expected anybody to pay the higher rate. Not the borrower, not the broker, not the bank, not the investor who bought the loan. The reset rate was not a payment anybody planned to collect. It was a deadline. The plan, and it was an openly stated plan, was that in 2 years, your house would be worth more. You would go back, get a new appraisal, take a new loan against the higher number, pay off the old one, and start a fresh 2-year window at a cheap rate. Think about what that actually is. That is not a mortgage. That is a lease with a renewal option. And the renewal fee is paid by the appraiser. For a while, it worked beautifully. The Boston Fed tracked it. Of the 228s written in 2003, roughly 60 to 70% were gone, paid off and replaced before the reset ever arrived. The loans were never built to be repaid. They were built to be replaced. Hold that sentence. You are going to see it 3 more times in this video, wearing 3 different suits. And when we get to the end, notice that Bitcoin is the only thing we will discuss that was never built to be repaid or replaced, because it never borrowed anything from anyone. So, house prices at an all-time high, and borrowers defaulting at rates nobody had seen. Here is the answer, and it is so simple it is disturbing. House prices did not have to fall. They only had to slow down. The San Francisco Fed ran 309 American metro areas. They found a strong negative correlation between how fast prices had been rising and how many subprime borrowers were behind by 2006. Correlation coefficient 0.79. That is not a hint, that is a fingerprint. And measuring deceleration specifically, prices still rising, just rising slower, the correlation with climbing delinquencies was 0.61. The median subprime delinquency rate across those metros in 2006 was 12.2%, while prices printed records. Why? Because the machine never needed prices to be high. It needed them climbing fast. Follow the arithmetic, because this is the whole video. You owe $180,000 on a $200,000 house. 2 years at 15% a year, and that house is worth about $265,000. New loan against 265, pay off the old 180, cover the fees, room left over. The latter holds. Now run it at 8%. Same house, same borrower. 2 years later, it is worth about 233. You still owe 180. Take off closing costs, points, and the prepayment penalty, and there is not enough new loan to retire the old loan. The house went up, your equity went up. You still cannot refinance. That is the entire 2008 financial crisis in one paragraph, 2 years before anybody called it a crisis. Nobody's house lost value. The rate of gain shrank. The ladder stopped reaching. Watch it happen in 3 numbers. The 2003 loans, 60 to 70% refinanced out before reset. The 2005 loans, under 60%. The 2006 loans, fewer than 1 in 3 refinanced within 18 months. 70, 60, 33. The ladder did not snap, it shortened, and people fell off in the order they had stepped on. The price crash came a year later. The panic came 2 years later. Lehman came almost 3 years later. All of it was the echo. The event happened quietly in 2006, in a year when every headline said housing was fine, because the headline number was still going up. Here is what it cost the man watching this. It was not only the people holding those loans. Everyone who owned a house, a bond fund, a bank stock, or a pension got repriced by a mechanism they had never been told existed. The loss did not come from being wrong, it came from watching the wrong number. And one more thing came out of that wreckage, and it is not a coincidence. On the 3rd of January 2009, 3 years after the ladder shortened and 4 months after Lehman, the first block of Bitcoin was created, and the person who created it wrote a newspaper headline into it about a chancellor on the brink of a second bailout for banks. Bitcoin was not invented as a technology looking for a use. It was invented as an answer to this exact machine by somebody watching this exact machine fail. So the only question worth asking is where that machine is now. On the 30th of March 2026, the Department of Labor published a proposed rule. It creates a safe harbor. In plain English, a legal umbrella. It tells the person running your workplace retirement plan, follow these 6 steps when you pick an investment, and if it later blows up, you are much harder to sue. The 6 steps are performance, fees, liquidity, valuation, benchmarks, and complexity. Sounds responsible. Sounds like homework. Here is what the umbrella is for. That rule flows out of an executive order signed in August of 2025, and the assets it covers are not stocks and bonds. It covers private market investments, interests in equity and debt that do not trade publicly, real estate, commodities, infrastructure, and, written into the text, actively managed vehicles that invest in digital assets. That last clause is the Bitcoin clause, and it is doing something almost nobody has noticed. The same paragraph that opens American retirement money to an asset priced by the man who sells it also opens it to the one asset on earth whose supply no man can touch. The comment period closed on the 1st of June. As I record this, it is proposed, not final. I want to be precise about that, because credibility is the only thing I actually sell here. Nothing has passed. A door has been unlocked and is standing ajar. The room behind it holds $49.1 trillion. That is what the Investment Company Institute counts in American retirement assets. The largest pool of patient, captive, slow moving money on Earth. And for 40 years, it has been almost entirely locked into things with a public price you can look up on a Tuesday. Senator Elizabeth Warren put out a video about this 2 days ago, and it has been seen more than 100,000 times. Her warning is right as far as it goes. Private equity is coming for retirement accounts. But she stops at who is coming. Nobody is opening up what is inside the thing that is coming. So let's open it. Here is how private equity is supposed to work. The fund raises money, buys a company, improves it, sells it 3 to 5 years later to somebody else, and hands the cash back. Buy, fix, sell, distribute. Everything in that depends on the word sell. There has to be a next buyer. Look at what has actually been happening. The average time a firm holds a company before selling used to run about 4.9 years across North America. By 2023, it was 7.1. Bain counts 32,000 companies sitting unsold in private equity portfolios, worth $3.8 trillion. And by the middle of this year, that count was pushing 33,000. In 2023, that pile was 3.2 trillion, then 3.6, now 3.8. It is not clearing, it is aging. 52% of that inventory has been held 4 years or longer, the highest share ever recorded. And here is the number that says the ladder is already short. For 4 straight years, the cash these funds actually handed back to investors ran below 15% of the value of what they hold. 14% over the 12 months through the third quarter of 2025. Record lows. The next buyer did not show up. So now what? The manager sets up a brand new fund, raises fresh money into it from new investors. That new fund buys the company out of the old fund. The old investors get paid, on paper, and the manager books it as an exit. In the trade, it is called a continuation vehicle. Sit with the shape of that. The company did not get sold. It got refinanced. New money in, old money out. Same asset. And the manager sets the price. That is a 228. Structurally, mechanically, precisely a 228. The homeowner in 2006 paid off the old loan with a new appraisal on the same house. The manager in 2026 pays off the old investors with a new fund on the same company. The asset never moved. Somebody wrote down a number. And the whole thing only works if the next number is bigger than the last. It is not small. Continuation vehicle volume was 52 billion in 2023, 74 to 84 billion in 2024, 115 to 116 billion in 2025. In the first half of this year alone, manager-led deals ran 65 billion, up 35%. Continuation funds now make up roughly 89% of all manager-led transactions. This is not a niche instrument. It is most of how the exit door works now. And the appraisal? Single asset continuation vehicles, the purest version, one company sold from the manager's left hand to his right, priced at an average discount to stated value of 2.9%. If your neighbor sold his house to himself and produced an appraisal 2.9% under his own asking price, you would laugh at him. When it happens with $116 billion of retirement money, it gets an acronym and a favorable rule from the Department of Labor. And that is the asset class being proposed for the 49 trillion. Not the private equity of the textbook where somebody pays cash. The private equity of 2026, where the exit is a refinancing and the appraiser owns the building. Which means money in an American retirement account would be buying a structure that survives on the same thing the 2006 mortgage did. Not high prices, rising prices. Rising fast enough, long enough, that the next fund can always pay off the last. Bitcoin has no continuation vehicle. There is nothing to continue and nobody to continue it. Nobody rolls Bitcoin forward. Nobody remarks it at quarter end. And no manager decides what it is worth this Tuesday. That is not a slogan. It is a structural difference. And it is the entire reason the rest of this video matters. That is what this costs you. Not a crash, a dependency you were never told you had. I keep one number on my dashboard for exactly this, and it is not the stock market. It is what your savings would actually pay you per month if you had to live on them. If this were only private equity, you could shrug and say you do not own any. Fair enough. Except the same machine is running the largest trade on Earth, and you almost certainly own that one. In March, OpenAI closed the largest private funding round ever recorded, $122 billion, at a valuation of $852 billion. The company has never earned a profit and loses money at scale every year. So how does a company that loses tens of billions a year pay its bills? The same way the 2006 homeowner did. It raises a new round at a higher valuation and uses it to cover the obligations from the last one. The rising valuation is not the scoreboard. It is the income. The obligations are enormous because computing power here is bought years forward on contracts you owe, whether you use the machines or not. Microsoft, Oracle, Google, and Amazon book those promises as backlog, guaranteed future revenue. Roughly $2.1 trillion across the four of them, and analysts tracing those contracts estimate about half of it is owed by two companies. Neither earns a profit. Oracle alone carries $638 billion, up 363% in a single year. Then it goes one step further, exactly like 2005 did. The platforms are not waiting for the money. They are borrowing against it. The signed contract is the collateral. Planned capital spending is around $725 billion this year, up 77%. And Epic AI has that spending crossing above the cash these businesses actually generate right about now, this quarter. Past that line, every marginal dollar of construction is borrowed. Trace the chain. Money is lent against a signed promise. The promise is made by a company with no profit. It can only be honored by raising a bigger round, which requires the valuation to keep climbing, fast. Wall Street calls that locked-in demand. Traced to the source, it is a $2 trillion loan to a borrower with no income, secured by the assumption that the next check is larger. Notice what Bitcoin's supply did over that same year, while Oracle's backlog rose 363%. It rose by the amount written in the code in 2009, and not one Satoshi more, because there is nobody with the authority to add any. And here is why this lands on your kitchen table, whether you have ever typed a word into a chatbot or not. Roughly 40% of the S&P 500 sits in 10 companies. If your savings are in a broad index fund, you are not spread across 500 businesses. A very large slice of your money is one bet on one belief. And this is the belief. It does not need to crash. Remember 2006. It only has to slow down. There is one more. It is the biggest, and it does not even try to hide. As of the 5th of August, the gross national debt of the United States stands at $39.83 trillion. The Joint Economic Committee's own tracker projects it crosses 40 trillion around the end of this month. 3 weeks. It grew 2.88 trillion in 12 months, roughly $7.9 billion a day. Everybody knows the number is big. Almost nobody looks at the mechanism, and the mechanism is the point. The United States does not repay its debt. When a treasury bond matures, the government sells a new bond to pay off the old one. Roughly $10 trillion, about a third of all marketable treasury debt, comes due and must be replaced this year. The debt is never repaid, it is replaced. Where have we heard that? The 2006 homeowner refinanced against a rising appraisal. The manager refinances against a valuation he wrote himself. OpenAI refinances against a rising round. And the Treasury refinances against the world's unshaken belief that America keeps growing. Four borrowers, one requirement. The next check must be bigger than the last. Bitcoin has no maturity date. Nothing comes due. No auction has to clear on Thursday, and no rollover can fail, because Bitcoin never borrowed anything from anybody. That is not a feature somebody added. It is what is left when you remove the issuer. And these structures are not side by side, they are stacked. Belief in American technology holds up the index. The index holds the world's savings inside American markets. Those savings show up to buy the next treasury auction. Pull the bottom, and you have not damaged a floor, you have moved the foundation. All of it while the interest bill alone runs over $1 trillion a year, more than the entire military. Here is the part I have not heard anybody say out loud. Everyone tells this story with three borrowers: the homeowner, the company, the government. There is a fourth person in it, and he is not borrowing anything. He is the one being borrowed from. He is a 68-year-old man with a paid-off house and a retirement account he spent 40 years filling. He never took an exotic loan in his life. He never bought a private equity fund. He may have never used artificial intelligence for anything. And every one of these three structures is standing on his money. The mortgage machine was funded by his pension buying mortgage bonds. The technology trade is funded by his index fund. The treasury is funded by his money market account, his bond fund, and his bank's balance sheet. He is not a participant in any of it. He is the collateral under all of it. That is the theft, and it is not a dramatic word. He was never asked, never shown the structure, and handed a statement with a balance on it that was marked by the same people who needed it to be high. Which makes the honest question not whether he should be angry, but what he is supposed to hold instead. Everything on the menu he was given is somebody lending his money to somebody else. Bitcoin is the only thing he can hold that is not a loan to anyone. Line them up. The 2006 appraisal had an appraiser, a person in an office who wrote the number that decided whether the ladder reached. The continuation vehicle has a manager. He owns the company, sets the value, sells it to himself, and books it as a win. The technology backlog has a chief financial officer who decides what counts as guaranteed revenue. The Treasury has a Federal Reserve that decides what money is worth and how much of it exists. And the things your savings are supposedly diversified across, the index, the bond, the fund, the dollar in the account, every single one has a name on it. Somebody's promise, somebody's mark, somebody's printer. They are about to make this much more literal. And this is where that rule stops being a footnote. They are going to tokenize everything. Not as a theory, as a build schedule happening in public. Your equities, your bonds, your credit, your house, your savings, all moved onto digital rails and traded in fractions, around the clock, by anyone. And when everything you own is repriced onto those rails, exactly one question survives. Which of these has no issuer? A tokenized bond still has a treasury that can issue more. A tokenized house still has a county registry and a taxman. A tokenized fund still has a manager who marks it. A stablecoin still has a company. A central bank digital currency still has a central bank, and no central bank in history has ever looked at a printer and decided not to touch it. Every exit they are building for you still has a man attached. Everyone except Bitcoin. 21 million. That is the whole argument. 21 million Bitcoin. Fixed. Forever. Not a policy, not a target, not a mandate somebody voted on that somebody else can unvote. No board meets about it. No appraiser writes it. No manager marks it. No chairman can be leaned on during a bad quarter. Bitcoin has no servers. It has a protocol. I want to be careful here because this is where people overplay the hand and lose the room. I am not telling you Bitcoin goes up next month. I have no idea what Bitcoin does next month. And anybody who tells you they do is guessing with confidence. What I am telling you is narrower and much harder to argue with. Every asset in this video required a next lender. Bitcoin does not have one because it never borrowed. No obligation to roll, no valuation to defend, no appraiser to keep sweet, no auction that has to clear. The supply schedule was written once, and it does not negotiate with a bad quarter. Now put that against what 2006 taught us. Every structure we walked through dies from deceleration, not collapse. From the merely disappointing. Slower price growth killed the mortgage machine at record highs. Slower valuation growth is the live risk to the technology trade. Slower belief in American growth is the live risk to the treasury. Bitcoin cannot decelerate in the only way that matters. Because what matters about Bitcoin is not its speed, it is its ceiling. 21 million does not care how the quarter went. Let me take the obvious objection, because it is a good one. Bitcoin has barely moved in weeks. Some of you are watching this thinking flat is failure. Take it the other way. Everything in this video had to keep rising to stay alive. The mortgage had to, the fund has to, the valuation has to, the debt has to. Bitcoin did not have to do anything at all this week, and it is still exactly what it was. 21 million, no issuer, no man. That is what an asset with no counterparty looks like on a quiet Tuesday. It looks like nothing happening. That is the feature, not the flaw. And here is the irony inside that proposed rule. The same document that would let a manager put his self-appraised fund into an American retirement account also names vehicles holding digital assets. Washington has, in one rule, opened the door to the asset whose price is set by the man selling it, and to Bitcoin, whose supply nobody on earth can set. Same menu, same plan, same man choosing. One of them is a promise, one of them is not. So what do you do with it? 4 parts, and the last one is the one people skip. First, you cannot time this. In 2006, the mechanism was visible, sitting in Federal Reserve research papers, and the people who saw it looked wrong in public for the better part of 2 years while prices printed records. The mechanism is knowable, the calendar is not. Anybody handing you a date is selling something. Second, watch the speed, not the level. Not how high the market is, but how fast the next round prices above the last. Not how enormous the backlog is, but whether it is clearing or just aging. Not whether the debt is big, everybody knows the debt is big, but what rate the Treasury has to pay to roll the same money. Headline numbers look wonderful right up until the last day. Rates of change do not. Third, know what you own and go look. Not the balance, the contents. Ask one question of every line. Does this depend on somebody else's promise staying believed? For an index fund, that is one belief, and you now know which. For a private fund inside a retirement plan, ask who sets the price and how often it trades. For your cash, ask who can make more of it. Some things have a counterparty. One thing on that list does not. And Bitcoin is also portable, divisible, verifiable by you personally, and fixed at 21 million. Fourth, and this decides how people actually come out of these things, manage your own head. If this holds for another year of record highs, and it might, the crowd will tell you that you were wrong, that this time is different, that you missed it, that pressure has ruined more savers than any crash. The people who came through 2008 intact were not the ones who called the date. They were the ones who understood the machine well enough that they did not need one. I am not going to tell you to go buy Bitcoin. That is not what this channel does, and a man who spent 40 years building a nest egg does not need me shouting at him. You have the math, the mechanism, and the one question that sorts every asset you own into two piles: the ones with a man attached and the one without. No certainties here, only probabilities. But the probability that the world keeps repricing away from promises and toward the one thing nobody can print more of has been rising for 17 years, and it has never once gone the other way for long. The door is open. It has been open the whole time. It just does not have a salesman standing in it. Free, no credit card, about 2 minutes. Take the money quiz at timtalksfinance.com/members. It shows you what your savings would actually pay you every month if you had to live on them, what inflation is quietly taking off the top, and one move worth considering for your situation. That monthly number is the one figure in your financial life nobody else gets to mark. I built it so you would not have to work this out alone. Watch the speed, not the level, and keep an eye on the only number in this entire video that nobody is allowed to write down: 21 million.